Now, capital budgeting. Capital budgeting is something that you also do. Sometimes when you don't have money, what do you normally do? Hello. When you don't have money, you always plan with the most important things, right? So the money that you have, lazima ujipange. Unasema sasa sahi nitabuy unga nusu kg, right? Half or 1 kg. What you can afford. Na nyama unabuy a quarter because that is what you can afford. And then unachukua ile mafuta ya kupika kadogo, ile ya kupima, right? So what are you trying to do is that you are trying to budget so that your capital can be able now to give you the benefit that you want as at that time. Now, the same thing happens in investment. When you invest and you're the finance manager and you have some limited capital, you need to budget with it. So it is capital rationing. You need to ration it so that you can be able to get the best out of it. You might be having so many projects. And those projects you have to balance and check which one is going to give you the best, the most benefit. So you start with the most beneficial project, the project with the highest benefit or profit, right? Another issue is that sometimes you can be running 3 projects at the same time. There are projects that must be done together, and then there are projects that you either pick one of them. Projects that you pick one of them, those are called mutually exclusive. So if you pick A, then you forget about B because A can satisfy the need. Like for example, you have some little cash and you are wondering whether to buy Milo, you buy cocoa, or you buy tea, right? Tea leaves. You pick one of them. Once you bought Milo or tea, then tea leaf, then now you leave the rest, you move to another one, right? And at the same time, we have projects that are mutually inclusive. That means that you can be able to do all of them at the same time. Like for example, sugar na unga. You can buy all of them because they don't substitute each other. So you can pick all of them. Now, when you are doing capital budgeting, you want to get, even if you're talking about mutually exclusive projects that can be able to, can replace each other, you can pick one of them. Even if you are considering those ones, you have to know among the two, which you have to pick one, which one has got the highest profit, the highest return. Now, in capital budgeting, we normally call profits net present value. That is how we refer to them. So that means that you'll be able now to compare and get the best one, which is called net present value. But before that, you need to know that these projects, before you pick them, you need to rank them so that you can be able to know which one is leading, which one is number 2, which is number 3, and so forth, so on and so forth, right? So when you are ranking projects, you normally rank them using what is called profitability index. Ranking of projects use profitability index. Use profitability index. So profitability index is what we use to rank the projects, and profitability index is basically PI. So you can say profitability index, which is also the same as PI. Profitability index is equal to the NPV of each project all over the cost of that particular project. So let's say that if the NPV is high compared to the cost, then that project will be having a higher profitability index. Let's take example. So that is how you're going to rank them. Let's take example that one project is giving you 1,000 and the cost of this project is 200. In this case, we are going to have 5, right? That is the profitability index. Then we have a situation where this project is now having a lower NPV. Let's say maybe like 800, but the cost is still the same. You are going to have 4. So you can see that the more the profit, the NPV, it means that it gives you more profit than the cost, the higher the profitability index. The more the profit or the more the NPV, the higher the profitability index. Now, that's basically what we are going to learn today. And then if we have time, we shall now go to linear programming. I want to write that, start by saying that capital rationing, I hope you've written it. Capital rationing implies investment in projects. Capital rationing implies investment in projects. Capital rationing implies investment in projects. Projects with limited capital resource, within limited capital resource or resources. It refers to investment in projects where you have limited capital resources, within limited capital resources. Capital rationing refers to investment in projects within a limited capital resources, within limited capital resources. So you have limited capital resources and you have to budget within that capital that you have, within that limited capital that you have. So that is what we are referred to a capital budgeting. You need to budget such that the cost or the budget fits in within the amounts that you have. You proceed and say, it is the process of allocating resources. 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 It is a process of allocating resources among different projects, 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 where the amount of money to be invested is limited, where the amount of money to be invested is limited. It is the process of allocating resources among different projects where the amounts to be invested is actually limited. The amount to be invested is limited. The amount to be invested is limited. So basically what we are saying is that it is about how a company will be able to, or decides how to allocate their capital among different projects where we have limited resources. You proceed and say that the main goal is to maximize the return on their investment. The main goal is to maximize their return on investment. The main goal is to maximize their return on investment. The main goal is to maximize their returns on investment. The main goal is to maximize return on investment. Now, let's look at the types of capital rationing. And first, what causes capital rationing? It means that you have less money. The challenge of capital, you don't have capital. We shall look at that. So let's look at the types of capital rationing. Types of capital rationing. Types of capital rationing. Number one is called internal or soft. Internal stroke soft capital rationing. That is number one, the first type of capital rationing. So this happens this way. When a company can decide to have a policy that with them, they want to invest just small amount of money, or they will want to only invest on projects that can give them good amount of money. Or they can say that with us, we want to retain our cash flow. We want to have enough reserve. So we only allocate small amount of money to the project. It is not like they don't have money, but they have decided probably they want to pay more dividends very soon, right? Or they want to think about their economic conditions first before they invest. So such kind of reasons can make them to ration the capital that they have. Now, this one is normally a policy that is that is actually implemented, or we can say that it's a policy that is put in place by the company itself. The company ndio inajipanga, restrict the amount of capital that they're doing or they're going to place. I want to say under the same, you can say that soft capital rationing is where a company imposes its own spending restriction. It is where the company imposes. It is where the company imposes. It is where a company imposes its own spending restriction. The company imposes imposes its own spending restrictions. In bracket, you can say this goes against the concept of shareholders maximization. In bracket, you can say that this goes against the concept of shareholders maximization. This goes against the concept of shareholders maximization. This goes against the concept of shareholders maximization, which occurs by always investing in positive NPV projects, which occurs by always investing in positive NPV projects, which always occurs by investing in positive NPV projects. So what are we saying? Hiyo kisungu ya mwisho inasema that ordinarily investors, when they bring money, they don't expect you to borrow the money. They need you to invest on every project that you're having, as long as those projects have got positive NPV, meaning that as long as those projects make profit, you need to invest, because at the end of the day, they want their money to give some benefit. Wanataka pesa yao izae. So as long as they have given you the money, shareholders, they contribute and give you the capital. They want to know how to spend it, even if they are making a small amount of money, because their main aim is to maximize their wealth, right? So that is why we are saying that this one is where the company in itself imposes this restriction. Though, in bracket, we are saying that though this goes against the expectation of the shareholders, where they will want you to do what? To maximize their benefit. So that is what I'm saying, that it is where a company imposes its own spending restriction. And then in bracket, you say that this goes against the concept of the shareholders maximization of profit, of course, which occurs always when they are investing in positive NPV projects. So what are the reasons for soft capital rationing? Reasons or causes? Reasons or causes? Reasons or causes of or reasons for soft capital rationing. Number one, limited management skills in new area. Where the area where they are supposed to invest, they don't have much knowledge or skills. So they are being skeptical. Wanakaa chonjo kidogo. Hawataki kuweka pesa yote huko inasapotea kwa sababu hawana experience and they cannot predict clearly what will happen. So they put some small amount of money there. They restrict as they test the waters. So that is limited management skills in the new area. Limited management skills in the new area. That is the first one. Number two, we say wants to limit exposure and focus on profitability, and focus on profitability of small number of projects. So what are you saying? The company might want to limit its exposure. Instead of putting the whole money somewhere, they ration. So wanaweka kapisi kadogo hapa pale, what we call portfolio management. So you don't put all your money in equity or all your money in Safaricom. You share so that you reduce the exposure by putting money in small projects. That is also about rationing. So ile pesa uko nayo umejipanga. That is another one. Another reason is to avoid, we can say that, the other reason could be the cost of raising the funds, where there is high cost, where there is high cost of raising the funds or finance, raising finance, where there is high cost of raising finance, where there is high cost of raising finance, and also to avoid dilution, of shares. And you know how you can be able to dilute shares? Normally, we can decide to go outside and call more people or shareholders to bring money so that we can invest. We don't want to reason and we don't want to say that we don't have money. We simply invite other shareholders to come or increase the amount of shares so that we can be able to invest that money. We have enough capital. But a situation where we don't have to increase, we don't want to increase the number of shares. What do? We restrict and only use what we have. We only restrict and use what we have. So that could be another reason or causes of capital rationing, which is internal. That can also be another cause of internal capital rationing. Internal capital rationing. Another one. Wish to maintain high interest cover ratio. Or let me say to maintain control. To maintain control. To maintain control or reduce EPS by issuing shares. Maintain control or avoid issuing shares. Avoid reducing EPS through issue of shares. Now, when you issue shares, there are two things that will happen. When you issue shares, number one, you are going to dilute the shares so that EPS per share is going down. Another problem that will come is that you're going to lose control. Because now voting powers will be spread among so many people. So many people will be shareholders. So to avoid that, they can actually do that. So let's look at the other type, which is now called the hard capital rationing. Hard capital rationing. That is the second type. This one should be rationing, not rational. Rationing. Hard capital, that is number 2. Hard capital rationing. So now in hard capital rationing, this is where you are restricted by the by external factors. It is not a policy within the company to restrict how much you are spending. It is now the forces from outside. Ungetaka sana kuwa na pesa, lakini sasa hakuna hiyo pesa. Like for example, the banks have restricted how much you can borrow. Like for Lisa, some of you I know you are like me. You can be going for those short-term loans. Now the bank has reduced your credit rating. So that is what we call hard. Sio kupenda kwako, sio. So what do we say about this? I want to say that under hard, I want to define it and say that it is due, hard rationing is due to external factors such as bank restricting the amount to lend. It is caused due to external factors. It is caused due to external factors like banks reducing the amounts to lend. They are restricting the amount to lend. So let's look at reasons why we have this. Reasons for external or hard capital rationing. It is also called external. You can call it external or hard capital rationing, also known as external capital rationing. It is also known as external capital rationing. So the causes, number 1, industry factor. Industry reasons or causes of external stroke hard capital rationing. Industry factors such as recession. When the economy is in recession, that can actually cause that, because what happens is that the bank will not want to give out. The banks will not want to give out money. The banks will not have to give out money. Number 2, the company's poor track record. Your company is the company poor track record. You are known not to be paying back. The company's poor track record. Low credit rating. Company's low credit rating. Company's low credit rating. Company's low credit rating. Where a company has no assets to secure a loan. Where a company does not have assets, where a company has no asset to secure loan where a company has no assets to secure loan, so they are restricted because of their policy. They cannot be able to get loan as they would expect. Another one, where the capital is in short supply. For example, the government could have borrowed money in the market, so there is no money in the market, where there is short supply of capital, short supply of capital in the market. Short supply of capital in the market. Number 6, high risk of borrowing, maybe because of high interest rates. High risk of borrowing, or high risk of borrowing. Or lending. There could be risk in lending where the bank will not want to give you money because the bank knows that your company is not doing well in terms of liquidity. So the company might have going concern problems. So they can increase the interest rate to an extent that you cannot be able to manage. So those are some of the causes of external or hard capital rationing. That is a question that was set in the last sitting. They were asking about the same question, number 1. To explain the causes of external capital rationing, and they only wanted you to give 4. That was the last sitting question. 4 reasons or 4 causes of hard capital rationing. That was question number 1. Okay, now let's look at how to mitigate this. How do you mitigate, or let's look at the importance first, importance of capital rationing. Benefits or importance of capital rationing. Why is it good to ration the money that you are spending? Importance or benefits of capital rationing. Importance or benefits of capital rationing. What are the advantages of this? Advantages. Number 1, it helps the company to invest in projects with high returns only. Helps the company to invest in projects with high return only. You can only focus on investing on high return projects. That is the first advantage. The second advantage is that it helps to improve cash flow before making investment. It helps to improve cash flow. So before you make investment, you hold some money and relook at your cash flow before making investment. It helps to monitor the cash flow before making investment. That is another advantage of capital rationing. The next one, that by limiting the projects where you are investing, you are able to manage the projects. You know, if you invest in all projects at the same time, so many projects at the same time, managing them will be a problem. But if you ration, you'll be able to take your time and monitor a project before you start the other one. So we are saying that limiting those projects makes it easier to manage. So you can say that limited projects are easy to manage. Helps to manage limited projects. Helps to manage limited projects. Helps to manage limited projects. You can easily manage limited projects. The other reason is flexibility on investment. When you are investing in projects one at a time, you can easily make decision to diversify and leave something that could be more risky. You are so much flexible because you have money. Ukiona hili yaendelee vizuri, you can easily shift to another one. So that kind of flexibility comes in when you are rationing how you spend or invest. Rather than investing once the full amount of money in a certain investment. So it also makes the funds readily available for any emergency. Make funds readily available for any emergency. For any emergency. The funds are readily available because you don't spend all of it at the same time. You'll always find some money at any given time. So it creates reserves on cash flow. Creates a reserve on cash flow. Creates reserves on cash flow. So let's say that maybe end of the year you want to pay dividends. You have a reserve, you can be able to pay them because kuna pesa umeweka kando. Instead of investing yote, and then when the shareholders come at the end of the month, you don't have anything, or at the end of the year, you don't have anything to give them. Now, what are some of the challenges that comes with this? The challenges. So let's talk about challenges or disadvantages. Challenges or disadvantages of capital rationing. Guys, be joining class. It is quite demoralizing that people miss class the following day they ask for videos. Kindly join class so that you can have forum class in the day. Any classes at Sunday. Somebody cannot say bad about jobs here. But when I log out knowingly, or they don't join intentionally, and that will not be possible. Hakuna kushare videos. Just join class as per the timetable. So, what are some of the challenges that we're going to have? Number one, when you are rationing, you might have to need high capital of money. If you have so many projects and you want to invest kidogo, sometimes because your intention is to invest in projects that can give high return, it can require high capital of money or high capital requirements. Might lead to be invested in those piecemeal projects. That can be one. You can also find yourself having a low dividends at the end of the year. Reduction on wealth creation. Reduction on wealth creation because of low or hence lower dividends. when you're trying to be more skeptical that you want to keep some money, you don't want to invest at the same time all, it might lead to low investment. And you know the repercussion when the dividends are low because you didn't invest the whole money, you kept some as a reserve. What will happen? The shareholders can decide to withdraw their money. If they realize that you don't invest your whatever they have given you well, they can decide to withdraw their money. Again, it is expected that for us to have efficient capital market expects you to have free flow of money. When you are keeping some money as reserve, you are holding money. It means that money is not moving freely in the market. So that one goes against the principles of capital markets. So we can say, number 3, that it goes against the efficient capital market theory. It goes against efficient capital market theory, where money is expected to flow freely in the market. Expected to go freely in the market. Now, how can we overcome this? So you say overcoming capital rationing. How do you overcome the challenges that comes with capital rationing? Overcoming capital rationing. Number 1, you need to overcome capital rationing. Number 1, prioritize investments. Prioritize investments. So you need to start by evaluating projects that you need to give priority based on their expected return. Evaluate projects to give priority based on their expected return. So that you don't have challenges that you're going to have small amount of money and you want to now ration it among several projects. Just think about which projects should be given that has got the highest return, So prioritize your investment. Number 2, optimize cash flow. So what does that mean? Optimizing cash flow. You need to enhance cash flow. To avoid capital rationing. You need to ensure that you have so much money so that you don't have a challenge when you're investing, that you have now to ration the funds. Enhance cash flow to avoid capital rationing by implementing effective working capital management practices. By implementing effective working capital management practice. So, you know, the working capital, those are the current assets like the cash, receivables. You need to balance them such that you don't have much payables. You don't have a lot of money also spending outside. When you manage your working capital very well, you'll be able to have excess cash flow. And that cash flow can be used to run the projects. So what are you saying? That you don't have excess payables. You don't pay things that are not necessary. Hauna daily. And here, you make sure that people don't owe you money that is lying outside too much. you don't have so much debts. Because if your money is restricted or is stuck outside, then you have a challenge. So you need to manage your working capital, the capitals that are available that can be invested in the business. You need to manage them well. So that can be one of the ways of reducing capital rationing, because you'll be having enough funds. You can also seek external financing. Try to talk to people nicely so that they can give you money. Seek external financing. That can be through donors, grants. It can be through loans, right? So external capital financing will take you away from the challenges of liquidity problems. Seek external financing when you don't have sufficient amount of money. Collaborate and have joint ventures. Collaborate and joint ventures. Collaborate and get into joint ventures. Kama una pesa, fanye biashara pamoja, si ndio? But I can tell you it is not easy. It is not easy to be in partnership. It's not easy to be in business partnership. Somebody will be spending much time in the business while others are doing their own things. But they're saying that you need to also to consider that so that you can be able to gather resources. So that approach will be able to make you have leverage that will be able to complement your strength. It will leverage you and complement your financial strength. Number 5 is cost optimization. Reduce cost as much as possible. Cost optimization. Try to reduce unnecessary costs. Cost optimization. Try to reduce unnecessary cost. So you need to do a thorough cost analysis. Perform thorough cost analysis. Perform thorough cost analysis so that you can be able to identify expenses that can be reduced without compromising the quality of your services. You can reduce expenses by doing cost analysis without compromising the quality of your services. The next one, number 6, is continuous monitoring and evaluation. Continuous monitoring and evaluation. Continuous monitoring and evaluation. Continuous monitoring and evaluation. So that you can be able to reassess the ongoing assignment. You need to evaluate the assignments that you have started and then check if they're going to give you a very quick cash flow. Number 2, if they are actually beneficial, right? You can invest in projects that are elephants that will take a long time and will not give you any benefit until you abandon. So continue monitoring the ongoing projects. Check. Number 1, do you think that the money that you have can complete those projects? Because it is only when you complete those projects that you can be able now to generate income from them. Usianze kujenga nyumba hapa imekwama na unajenga ingine imekwama. As an accountant, you need to know that these projects will have less cash flow, but we need now to monitor. Number 1, when we are monitoring, we are going to reduce the cost in those projects. Number 2, we are going to finish very fast with the resources that we have so that it can start getting us cash flow, which can complement the ones that we have as reserves so that we can start new projects. So continue evaluating and monitoring the progress of these projects. That will be able to also help you identify underperforming projects, right? So that you can be reallocating resources. You can be able to reallocate resources to projects that are doing well. Number 7, so the projects that are going on, you can be able to know. Number 7, you can have a long-term plan. long-term planning. How is this possible? So that you can take long-term loans to finance long-term projects. Short-term loans to finance short-term projects. Why? If you happen to have a long-term project, then you finance it using short-term loans, it means that the loan will be due for payment before even you start generating revenue. And so you'll be asked, very fast you'll be asked to start paying, and you don't have money. So you'll be having liquidity problem. And the next thing is capital rationing, because you can't afford. You can't afford. You'll not even pay people salary. And so you now want even to ration the salary. You'll say that, okay, let accountant go. The receptionist can keep the books. Let our accountant go. It's very expensive, and the receptionist can actually keep the books. So this one will help you to consider future capital requirements. You will know how much you require in future, right? You'll also be able to time the maturity of investments. You'll be able to time the cash flow from these investments. You can be able to time the cash flows from this investment because you have a good plan in place. You have a good plan in place. Up to there, do you have any question about those? Okay, now let's now look at, you are free to ask questions. Let's now look at an illustration in terms of hesabu illustration on capital rationing. So in the question last semester, let me now read it. I think they brought it. The question was saying, look at question number 1. That one was actually application. You will just apply. Last semester. Hiyo pepa ngumu. Question number 1 ilikuwa nasema hivi. IT summarize 4 causes of hard capital rationing as used in capital budgeting. Summarize 4 causes of hard capital rationing as used in capital budgeting. So that one you could apply. Even right now, you can still apply. What can make you minimize the amount that you're using? Because the banks have refused to give you the money. That can be 1. You have poor record, that can be 2. You have liquidity problems, that can be 3. Or maybe there are questions of going concern. They want to doubt kama hii kampuni itaendelea kufanya kazi. So nobody can give you. So therefore, it is basically caused by external factors. And for them to do that, there are things that they have considered for them now to actually impose that kind of rationing. So let's look at illustration on how you can be able to do this project. So let's say that you have projects, illustration. Well, letter theory, maybe they can decide to bring a sample at some point. I'm not sure come at this time. So let's have projects here. Then we come IO, that is the cost of the project, initial outlay. Then we have revenue that you can be collecting. Revenue per annum. We have fixed cost per annum. Fixed cost per annum. And then we have number of years for the projects. Number of years for the projects. So now, let's have project A, B, C, D. Then we have E. Those are projects that are very independent. What I mean, that A is a project that you can decide and just run it on its own. It has nothing to do with B or C or D, right? So these are projects. These are projects. Just 1 minute. So we have here 10. We have 30. We have 15. We have 15, then we have 12, then 18. So then 18. Then we have 20, 30, 18, 17, 8. 20, 30, 18, 17, 8. Then we have 5, 10, 6, 8, 2. And then we have number of years. There are number of years n. So we have 3, 5, 4, 10, 15. Or 10, 15. Copy that. Let me know when you're done so that we go to additional information. Additional information down here, additional information. Additional information. The variable cost rate is 40%. The variable cost ratio is 40%. 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 Projects D and E are mutually exclusive. Project D and E are mutually exclusive. Projects D and E are mutually exclusive. Projects D and E are mutually exclusive. Project D and E are mutually exclusive. Projects D for dada, D for dog, and E are mutually exclusive. Number 3, the cost of capital is 10%. Cost of capital is given as 10%. The cost of capital is 10%. Cost of capital is 10%. Required, assuming that the company has a limit of 40 million, assuming that the company has got a limit of 40 million, assume that the company has got a limit of 40 million, determine the optimum allocation. Determine the optimal allocation. Assume that the company has got a limit of 40 million. Determine the optimal allocation. determine the optimal allocation. So here, we have to solve this very fast. We have money, but we only have 40 million. So you look at this, what are we saying? The projects that we have are all these. The total projects that we are having is, this is 40, this one is 30, plus this 45, so we need total of how much? For us to invest in all these projects, initial investment cost is going to be 85 million, but we only have 40. Are we together? The investment cost that we require is 87, 85, but we only have 40. So we have to ration and rank the projects and know which one can we actually spend our little money into so that we can have the maximum return, because we don't have much. We don't have much. So let's go to the solution. Solution. So we say that when you're doing capital rationing, the first thing that you need to know is what is the NPV, because at the end of the day, what will guide you is the ranking. You need to know which one is number 1, number 2, number 3, and number 4, so that you can be able to put the amount that you have according to the ones that can give you the best NPV. So that means that you need to rank them. For you to rank them, you're using profitability index. And the profitability index which we call PI is equal to NPV all over. Profitability index is equal to PV, not NPV, but PV all over IO. Profitability index is PV all over IO. So that means that you need to know which one has got the highest present value, so that you can give this one number 1, you prioritize number 2, number 3, until you finish the funds that you have. And then now you wait for the return. So that means that we have to calculate our present value first. So our present value, how do we do it? We can have the projects, call it solution. Let's get the project, the present value for these projects. So we have projects. And then we also have projects. So we have here number 1A, we have B, we have C, we have, let me just say C here, then we have D here, then we have E. Those are the projects. So if you want to get the NPV, you start by knowing what is the profit. So you start with the revenue. Still, that is what we learned. You need to know the revenue. So our revenue, so these are projects. So revenue, what is the revenue in project 1? Project A, what is the revenue? Revenue in project A. $20. So project A is 20, and we are told this one is revenue per annum. And we are told in the first question, the first additional information, that the variable cost of the projects, the variable cost ratio is 40%. So it is normally, the ratio is 40% of the revenue. So the cost, which is variable cost, is 40%. So it is 40% of what? Revenue. Because cost is normally part of this. This one has got 2 elements. It has cost and then it has contribution. So revenue is equal to cost plus contribution. variable cost plus contribution. So this one is part of this. It is the profit immediately before you remove the fixed cost, the profit that you get here, which we normally call gross profit. That profit comes from, it is also called the contribution, total contribution. So we are told that the variable cost is 40%. So it is 40% of that. That means that contribution is 60%. So in exam, they can use the term contribution, and then they tell you that contribution margin is 60%. That one should tell you that now the variable cost is the remaining percentage, which is now 40. Wakisema contribution is 60, it means that variable cost takes the balance because there are only two that makes up the revenue. So we are going to have our 40% here. So 40% of this is 8. Ordinarily, this is what we do. So we have 8. The second one is what? Revenue is 30. So 40% of this is 12, which we shall deduct. The third one is 18, then 17 and 8. 18, 17, and 8. So here, 40% of this is 3. What is the 40% of this? 18 times 40%. What is it? Can somebody give me the figure?
7.2.
7.2.
7.2. 40% of this?
6.8.
6.8. Thank you. 40% of this?
3.2.
3.2.
Thank you. Now, what is our contribution? Which we know it is 60%. So what is it? Here?
E is 4.8.
4.8. No. What E is 4.8. Okay.
Yeah, project 10.2.
4.8. 40% of you are giving me contribution where umeanza na is ungesema. So here is 4.8. That is it. Let's proceed.
10.2.
This one.
Yeah.
10 point.
I'm going back. 10.2. 10.8. 18. 12.
Now let's fix cost. Let's fix cost.
5, 10, 6, 8, 2.
5, 10, 6,
8, 2.
8, 2. Right? Now we are going to have profit before depreciation and tax. And because we don't have depreciation, do we have depreciation? So it is just profit before tax. Do we have depreciation? Do we have tax?
No.
So we don't have tax. And I told you that even if you are having depreciation, if there is no tax, then depreciation is irrelevant. Don't use it. Because you are going to deduct and then you add back, umefanya zero work. If we don't have tax, even if you're given depreciation, ignore it. That cash flow that you're having here is the same as the free cash flow because you're not going to make any change. It is only tax that should be deducted from here. So it means that what we are having here is the same as the cash flow. So this one is the same as the cash flow. Because there is nothing else that we're deducting. So get me the figure here. The first one is 7. 7 million. Here is
8.
Here
4.8. 2.8.
2.8. Ama mimi ndio na calculate by. Or the last one. So normally when we're getting our NPV or when we're getting our PV, present value, is normally the cash flow which we have now times PV or PVFA. PVFA. What are we using here now? These projects are independent. This is the cash flow per annum. Remember, these are revenue per annum, the cost per annum, the fixed costs as per annum. So even this one is per annum. Which one are we using? Are we using PVFA or are we using PV?
We're using PVFA because we are given the number of years for each project.
Yes. So these projects are not related. So don't count this one. You say this one is the same project at year 1, year 2, year 3. Those are the kind of mistakes that people make in exam. Unapata hivi unaanza kufikiria like this one is, they are irregular. Unafikiria ni irregular. So unasema these are year 1, year 2, year 3. No, these are independent project. Take A, forget about B. A, you're going to receive this one annually for the number of years that you're given. So it means that you're going to use PVFA. PVFA. So get me discounting factor, which we call PVFA for each project. So year 1, rate you're given as 10%. Get me the discounting factor there.
Two 2.48669.
Come again.
2.4.
2.4.
869.
2.4869. The next one. The next one. Tusaidiane please. Hapa ndio kazi iko. Hapa ndio kazi.
08.
I want someone else to give me the answer. Someone else to give me the answer.
Mwalimu, I have a question.
Yes.
I did not copy the whole question.
Mm.
I came a bit late. So how are we getting the first one? 2.4868.
2.4868. This one is PVFA. So PVFA, it has a discounting factor. But for each project, we are told the number of years. Can somebody share on WhatsApp what you've copied so that he can be able to see the number of years? Share, please. So it is just the number of years here. Additional information we are having the rate. So we have R, or rate of return. R has been given us 10%, and the number of years for each project has been given as well. Somebody to send so that we can help our friend. Very, very fast. We need to do another question from 2021. Another question of 2021 before we close, because that will be the end of that capital rationing thing. Sadi, I kindly take a photo and share. I thought this thing is very easy.
I'm sharing.
Huh?
I'm sharing. I am sharing.
So the number of years are at the end there. So now, give me the second one. It's the next project. 10% number of years is given there as 5 years. Also, Sadia, kindly also share. I can see Topista didn't copy. She didn't copy the benefits of capital rationing.
Okay.
So, can somebody give me the figures up? What are we doing, Germany? We are wasting time.
2.4869 was the project A.
Yes.
Then project B is 3.7908.
3.7908.
Project C is 3.1699. Then project D 6.1446.
6 point? No. How many years?
That was 10.
10.
Oh, so 6 point?
1446.
What?
1446.
Mm.
The last one?
Then project E 7.6061.
Let's multiply so that we get the total down here. Present values. Present values for each.
The first one is 17.4083. 17.4083.
The next one?
30.3264.
30.3264.
3264. 15.2155. 13.5181. 21.2971.
Okay. Now, we can get our IO for each project here. So IO, the first one was how much?
10.
So we had 10, then
10, 30, 15, 12, and 18.
10, 30, 15, 12, and then 18. So our NPV can be able to get our NPV.
7.4083.
The first one is 7.4083.
Yeah, then the other one is 0.3264. Then the other one is 0.2155. 1.5181.
7.408. Then this one is 0.1. 0.3.
0.3264.
264. This one is
Then 0.2155. Then 1.5181.
So that is where we are. So we have our NPV. So you can be able to see how much we are going to get from this project. If we pick this project, for example, still, you can be able to see that the benefit that we can get if we pick the project. This has got the highest NPV, still. And then we have these other ones. But we are not ranking it using the NPV. We rank them using PI, profitability index. So that means that we need now to calculate profitability index of each. So let's do this. PI, which I'll now say here, PI, write somewhere so that you don't forget, is equal to PV all over IO. It is PV minus IO. So get me PV minus IO here, 0 point. This one is now 1 point.
Divide. It is
So
divide, Malim, not
the PV is this one here. This one divided by this. This divided by this.
1.74083.
Don't make mistake and then get profitability index by calculating NPV all over IO. It should be PV all over IO like this. So here we are going to have our 7 point, 0 point.
1 point.
Oh, 1 point. 1.7
408.
And here
1.011.
1.0 give me 4 bar. Oh. 4 decimal places.
Okay.
What are you seeing there? This 1 point?
0.0 1.01 9.
The other one?
0119.
You know, Sadia, when you are now ranking them, it is good to be accurate, very accurate, because if you round off, utafika mahali upate zimeshikana, zimekai. Your mistake.
Okay.
So don't round off at
01.
when you are comparing. Wacha kila mtu asimame kivyake, hata kama kuna zero mbili, abaki na hizo zero mbili na zionekane vizuri. They will tie.
Okay. 1.0144.
1.0144.
I'm blocking the board, so I'll have to mute myself.
You see now, Sadia, if you are now round this one off to 2 decimal places, they will be equal to this. I see.
Yeah, 0101. Oh, I see.
So give me the other one.
The other one is 1.12.
She's blocking. Okay, someone else to assist now. Mute yourself. When you mute yourself, you're not going to block. Somebody again to give me the answers.
1.12.
1.12.
65.
So 1.1265. Thank you. Another one. Proceed.
21.
1.1832.
Okay, so those are the figures that we are having. That is what we are having. Can we now rank them? Ranking. So you say ranking here, right here, rankings or ranks. Ranks. So which one is number one? Which one has got the highest profitability index? That will be number one.
Project A.
So the project A will be number one. So you give it number one here, one. Followed by, so that means that when we are now investing the little money that we have, 40 million that we are having, the first 10 million will go on this project because this project will give us the highest profitability index. It has the highest profitability index. So we shall spend our first 10 million papa. Tunabaki na 30. Then go to project 2. Are you seeing how you rank them? And the reason why you're ranking them, so that you know which project will you spend money on. You look at this project. This one has got the highest present value compared to this. But look at the cost. This one is almost 3 times this. So you can be able to see that at the end of the day, even this profit, we are going to consume the whole of it. We are going to consume the whole of it. So there's no benefit. Therefore, you want to know how many times does the profit that you're having here goes into the cost. So this one goes into the cost how many times? 1.7. This one 1.0. Inaenda mara ngapi? Kwa hiyo sasa, so you need to be able to analyze it and understand. Okay, proceed. I need somebody to give
Project
me
E
another
is the
project.
second.
Number 2 is E. Professor is saying that E is number 2. So why is it number 2? Because this one is quite high, so that is okay. Number 3.
C.
Number 3 is C.
D.
Number 3 is D.
Yes.
So which projects are we going to take? We are told that D and E are mutually exclusive, meaning that you only pick one of them. Now that you have picked E, means that we are not going to invest in D, unfortunately. That is what they mean, and that is how you will be able to do it. Because if you happen now, if you pick D to be number 3, when you will be investing, utajipata umeinvest kwa hiyo D. At the same time, you have invested in E. Even though inakaa poa, but compared to this, you can't even think about it now because you've taken this one. So you ignore it when you are numbering. You can ignore it. Or even if you number it, when you'll be now rationing the money, please don't spend money on it. You can number it. But when you be spending money, please don't put money on it. It is not a priority now that we have E. Are we together?
Yes.
Yes, sir.
Okay, so this one, mimi nitalenga hiyo. So I'll give it, which one is now taking number 3? C.
C.
So C will be our number 3, and of course now this one is number 4. So this is how we're going to invest in these projects. This is how we're going to invest. The requirement was that assume that the company has a limit of 40 million, determine the optimal allocation. So we shall not allocate anything here. That is why we are ignoring it. So let's now have capital allocation. You have your notes here. So we allocate them according to the rankings. So you call it capital allocation. So you are told like that, determine the optimal allocation. So we talk about capital allocation schedule. Capital allocation schedule. Kindly mute when you are not talking, mute. Mute if you're not talking. You are not contributing here. So we have projects. Or let me just call it projects. Now, just have the projects here. Projects. Then we have the capital to be allocated. So we call it allocation. Then, because we are told to get the optimum, we can know the optimum depending on the profit that is going to give us. That is the NPV, net present value of each. So that is the net profit. Optima inamaanisha yenye itafanya vizuri, the one that will give us the highest return, which allocation. So we talk about now here, net present value. So it is this net present value that is going to show us how much we're going to get in total when we invest in them. So we started with project A. You start with the one that has got the highest amount of money. Meaning the one that has got, the one that became number one, sorry, the one that became number one. So the capital that we are allocating here, we have 40 million here. So that 40 million, we first allocate 10 out of 40 million. How much benefit are we going to get from there? What was the NPV? 7 point? Right? That is why you calculated NPV. Because that is the result. That is what will give us or will tell us the optimization. It will give us the optimum. Number two, we gave E. E required how much to be invested? E required how much to be invested?
18.
18, eh? So we have 18 million there. What was the NPV? 2 point? Or it was 1? Give me the NPV.
3.29708.
3.29708. Okay. So from our 40 million, are we together? We have spent 28. It means that we still have something good. We still have 22. Now we have 12 now. We have 12. That is still amount that we still have in our bank account. We can ration. So which project are we spending on again? Number 3 was?
C.
Number 3 was how much? C was how much?
15,000. 15,000.
15,000. So imagine we're back in a fellow when we are supposed to spend 15. You can't go to another project. You can't go to the fourth one. You have to invest in this. But sasa una invest ile pesa unayo. So we just invest a ratio of this. So it means that in C, even though it requires us to place 15, we can only manage 12. And you put it 12 with a star to remind you that you've not invested full amount. Then, if you say that if 15 million we invest will give us how much? What was the NPV?
0.2155.
And the NPV, net profit, it was 0.2155.
2.5.
So 0.2155. Then what about the 12 that we have managed? We have only invested 12. You don't bypass it. You have to invest in it, however little it is. Then you now ask yourself that, so you say 12 all over 15 times 0.2155. How much proportion, by investing this, how much is the proportion of NPV that you're going to have here? Get me the answer.
0.1724.
0.17.
172.
170.
0.1724.
24. So how much is the total NPV that we're going to get by investing like that? What is the maximum NPV that we can get depending on the amount that we're having? Add them. Add them.
$10.8778.
So we are having 10 points. 8778. 10.78778. So with our 40 million, here, we can get this NPV. That is optimal. So you say the optimal allocation would be like that. That is now the optimal allocation. So examine anajua, this is how best you could have allocated it to get you this, get your performance. I want us to look at this particular question. Look at what I've shared there. Get me the question for 2021. 2021. Which city? December 2021, question number 5. 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 Question number 5. Question number 5B. The A part of it was done in class during simulation class. Remember we did simulation? That is one of the examples that we did in class. So B part of it is what we're now struggling with. And we want to do it very fast because of time. You can go. Somebody to read. December 2021.
Which question? Question 5.
Question 5.
No. Explain for advantage of investing in real estate investor.
December
It is
2021.
question 4. Then it will be question 4.
Question number 5 says that. Question number 5B. December 2021. Due to restriction in capital markets. Are you seeing it?
December 2021.
2021 December. Yes, somebody to assist.
Question 3 was simulation. I had that one.
Kwani hawa wenye wamenyamaza pia waoni? Wote waoni?
I don't know.
Okay, I've seen it.
Si msaidie mwenzako jamani. Tofista now read it. Read. Are you all seeing the question?
Due to restrictions in the capital markets, ndio hiyo?
Yes.
Okay, due to restrictions in the capital markets, Rahim Limited Finance Manager is able to provide only 900 million shillings for investment in the next financial year. An analysis of the projects allowable for investment during the next financial year shows the following expected NPV. For each project, we have project PQRST. We have investments for each project and NBV for each project. Project Q and R are mutually exclusive. Required, advise the management on the projects to undertake.
Huyu ni mzuri. Are you seeing what he has done for you? Examiner ako sawa, eh? How can you calculate NPV for a student? CPS student. Eh? How? Eh? Children, they are making students become lazy. So these are the figures. We have here 300. They are in millions. We have another 300. We have another 600. We have another 300. So which kind of rationing is this? Which type of rationing is this? Huh? Which type is this? Tony, which kind of rationing is this? The examiner can ask you that discuss the advantages of capital rationing above. Which kind of rationing is that? And Topesta, which kind of rationing is this? Which kind of rationing?
I, I,
The question.
I
They are
think
saying that.
it's soft capital rationing.
Soft.
Yes.
Thank you. Another person?
Yeah, it is soft capital.
Where is the restriction? Is it in the company or it is in the external factor? It is an external factor. Huh? Where
It is
is it?
hard then.
Where? No. Sadi wamenicheza hapo. Wewe unajua ziko tu mbili. So if it is not soft, it is hard. No. No. We are told that the restriction is there. And who has imposed the restriction? Mnanicheza
Capital
hapa.
market. The
Hamwezi-
capital market.
With the notes that we have copied today, hamwezi kufanya hivi. Siwezi kubali. Siwezi kubali. Siwezi. Okay? So let's come to our solution. So our solution is to be able to, I think I can move these ones here so that we have our NPV here. So these ones are 120, 90, we have 150, we have 30, we have 12. Okay, so the solution is that now you need to get, we are told to do what? Require project Q and R are mutually exclusive. Advise the management of projects to undertake. So that means for you to advise, you need to be able to do what? To rank them and tell them this one is okay, this one is okay, here, Chana and I, after ranking them. And for you to rank, what do you need? The PI, so just go direct to PI. And so your projects will look like this. So you have your PI here, the profitability index, which we say that is equal to NPV. Profitability index is equal to PV over IO. Do we have PV? Do we have PV? Do we have PV? We don't have PV. What this examiner has done, I'm going to compare NPV, not just compare PV.
Yeah, but you can get PV.
What you need is the PV. That's all.
Yeah,
So,
I have to add back the initial outlay.
yeah, so now you have your PV here and say that PV is equal to IO, is equal to IO plus NPV. Sindio? Mlijua hiyo? Sindio? Ama kuna mtu tashwishi?
No, it is that one.
It's like that, eh? Because we normally say
Yeah.
that NPV is equal to the PV minus IO. So that means that we can make this one the separate matter. So if we make it the subject matter, we're going to have NPV plus this one ikirudi hapa inakuwa IO is equal to PV. So we can get our PV. So again, I'm warning you again. Usiingie kwa mtihani unasema hii ni rahisi na umechukua hii direct. Manze, you'll be wasting your 5 minutes. Alafu uende kwa question nyingine na umepata 0 kwa hiyo. You'll be wasting those 5 minutes that you use there. So we know that now we need to get this, and this is 40 for 20. Sindio? This and this, we have 3. Are we together? You just add.
750. Ama?
Oh, sio 500, mimi nimeona nini? 750, thank you. Okay. This one is 12. That is what is the question. Naka kadogo aje. Are they correct? Now, you can now come and solve this. So in exam, just do something like that. Prepare something like that, then start calculating for them. Show them that you attended class. So we have our, for 20, all over 300. So divide for me. What are the figures here? For 20 divided by 300?
1.4.
1.4. 390 divided by 300? 600. 750 divided by 600? Richard is making nice.
1.25.
Please, if you're not talking, just try to mute. You unmute yourself and talk, then you go, you close again. So what point?
2.5.
Thank you. That one is coming to 1.1. It's like 1.1. Give me the last one. We're almost done. Like we only have like 2 minutes and we're gone. So
1.08.
1.08.
08.
1.08. Ranks. So we have our ranks here. Guys, we agree. Understand the concept. Don't cram. Unaelewa kwa nini tunafanya hivi. So that you don't find yourself having 120 all over this, 90 all over this. You need to know that this one is NPV, but what you're supposed to use is PP. Then you get your PP and then come there. So which one is number 1? They are ranked like that. So we have number 1, number 2, number 3, 4, 5. Simple to zero. That is how they are. So you are told which project to undertake. How much do we have? So we come to allocation. Allocation schedule. So we have projects. We have A, or can I just call it projects? Yes. Let me just say projects. Then we have how much? We have
Mwalimu, there is something.
Yes.
There is something. Project Q and R are mutually exclusive.
Yes. So when you are allocating, ukijipata umeweka hapa, when you are allocating, remember to leave it out. So you can decide not to allocate here, you ignore it. But if you happen to have allocated, you have given rank. If you happen to have ranked it, make sure that now when you come to allocation, don't allocate because you pick the other one. So you skip. So let's come here. So allocation, or you can call it allocated amount. And then you have the present value, NPV. NPV. So we start with doing project. Number one is P. So you start with P. How much the initial cost? 300. So tumebaki na ngapi? From our bank account, we were having balance is now 600. Still, because we have taken 300 to cover it up. So what is the amount that you're going to have? NPV.
NPV 120.
NPV is 120, yes. Then we come to second project. Number 2 is, which one was exclusive?
P and R.
Q and R. Q. So if we take Q, we forget about R. So you are taking Q or R. Which one are you taking? Which project are you taking?
Q.
We take Q. So Q is going to be how much? 300. Then the NPV is 90. And then now we skip R. Right? And then come to S. So you have S. S is 300. Na hiyo pesa yako imeisha yote bila ndururu, bila anything. Hauna change. That is how you can be able to invest here. So you tell them, the examiner, after ranking, and we've used the money yote, naambia, pick project P, Q, and S. Project P, Q, and S. That will give you a total of how much?
900.
Here 900, but here you're getting how much?
240.
240.
240.
Yes. So invest in project, always advise, invest or accept project. P, Q, S. And you've seen why we've left it. You know, somebody will come and say that, oh, this one has got the highest NPV. Please, we are not ranking them with NPV. Don't make that mistake. You know, you can come and pick this and this. So you are going to have how much? This and this. You're going to have 270. And then you invest in these ones, pesa itatosha. Na hii itakuwa mingi 270. That is not what you're doing. Your decision is based on PI, not on NPV. This is what you are using to run, not this. So don't make those minor mistakes. Then you can find yourself getting into challenge. You're going to get a challenge. So in case you are told now to invest in this tool, that could be an alternative. But in terms of PI, this one has got the highest, PI. But this one is alternative. You can take this or this, but this has got the highest PI. Because of ranking.
So do we have a class tomorrow, or it is up to next week? You rescheduling the timetable?
No, tomorrow we will not have a class.
Okay, thank you.
So can we now proceed there from there on let me see. I think we can have a class tomorrow. Let's have class tomorrow. Because if you don't have it tomorrow, it means that this week we'll be having a challenge. Let's have class tomorrow to tumalize your topic. Sasa. Thank you.